the cherry picking around this study. I mean, it is cherry picking to the nth degree.
Yep. This is where I have a list of adjectives on the paper. I think nonsensical, hyperbolic garbage is what I wrote down.
Yes, yeah, for sure. And when you're used to working with the microphone, right, you have it like when you're a performer, you have it here.
That's right.
Right? Not, you're only here, right, if you're if you're belting, and
you're always belting.
I'm not always belting.
All right, get on with it.
All right, everybody, welcome to this episode of Bugle Notes. I'm Stephen Weitzel, joined once again by my partner, Michael Bennicelli. And today, in our latest podcast, we're going to be talking about this ephemeral concept of market timing. So Michael and I just recently published a white paper called You Can't Time the Market. And so we're going to be discussing that premise and the rationale that the industry tries to put out as a way to really diffuse any attempts that investors would have to sell or not be invested in the market. So
it's a concept that I'm pretty excited to go through because it's one of those things that just it's pervasive. If you've ever worked with an FA, you've heard them probably say that.
Oh yeah.
So it's throughout the industry, and it's something I think that needs to be unwrapped.
So let's just kind of start with the reason why we decided to write the paper.
So, in my mind, I think there's really three main reasons, right? Number one, it's kind of what we do, right? We take this, if you will, rage against the machine approach to the broader industry. Our thought process is that these things really should be questioned and not taken at face value. So, we almost feel like it's our duty to do that. So that's number one for me. Number two, I think the term itself is honestly it's poorly defined, right? I think there's a lot of things that get lumped into this bucket and that are called market timing that are not necessarily market timing as we would define it.
Sure.
And then third, a lot of the research that supports this idea or supports the idea that you should be fully invested all the time, you should only buy and hold, you shouldn't try to time the market is ill-conceived at best.
Mm-hmm.
I'm being generous. I'll use some other adjectives later on, but
yeah.
In my mind, those are the reasons that we felt like we really had to put this paper out there.
Sure. And it seems like that mantra of you can't time the market is something that we see most frequently in markets that are not going up or when there are bouts of volatility as just some way to dissuade investors out there from deciding to make a decision to exit the investments that they're holding.
Yeah, that's
right?
fair.
So I guess let's kind of get into how we might define market timing, or in general, what does the industry believe is market timing?
So maybe just read the paper definition there that we pulled, because I think that's where we kind of start our paper at. But
yeah, so we say the term market timing is defined as the act of moving investment money in or out of financial market or switching funds between asset classes based on some predictive method.
Right. So I think there's an important piece in that definition itself, and that it is, number one, predictive in nature, right? Mm-hmm. But I also think there's a number of things that are implied within that definition that are important to understand, right? So the idea that it's predictive potentially around some critical future event. The idea that it's generally short-term in nature or focused around short-term trading. You can even think day trading if you want to go that far. The idea that it's based around gut feel or instinct in a lot of cases, I think, is implied in that as well. So
sure, yeah, and we definitely would suggest that market timing would be some sort of a guess.
Sure.
A lot of times you have people screaming through the radio or on TV or YouTube about some imminent market top or a bottom that nobody is trying to sell or buy typically midstream, right?
Sure.
People are trying to call out some sort of an epic buying opportunity, selling opportunity.
I think within the context of our industry in particular, it's around those, we're at an event, right? We think something terrible is about to happen.
Correct. Yeah. And, it's probably not, it's not fair to label them all as scams. There certainly have been some. I'll tell you, I remember in the early days of my career, when I was working in a bank, getting a phone call from a gentleman who was anticipating having millions of dollars within the next few weeks because he had been pitched this idea of buying Iraqi dinar and that there was going to be some revaluation of that currency that was going to translate into him making millions of dollars. And it was you've got to buy this now because there's this seminal event that's going to happen. That would definitely fall firmly in the scam category. But, you hear on the radio every once in a while that there's something that's going to happen within the next 90 days that's going to change the course of, our financial lives forever.
Sure.
And it's always, you've got to act now to be able to protect yourself. And so these people they're making very bold predictions as a way to get people to take action.
Sure.
So
let me ask you a question, right? Why, in general, do you think our industry as a whole rails against this idea of market timing, or really just the idea of selling, right?
Well, so let's just say that there are two principal mistakes that an investor could make. The first one is they do something, they sell, they take action when they should be sitting on their hands doing nothing.
Mm-hmm.
The second is they sit on their hands when they should be doing something,
right,
when they should sell. And so I don't think that the advice of don't sell, don't be emotional, I think is maybe the construct around this idea of you can't time the market, you shouldn't sell. It's not that it's poor advice,
right,
on every occasion. It's probably 50% of the time, or maybe a little more, we get to the two mistakes, that people do something when they should be sitting on their hands.
Mm-hmm.
That they shouldn't be making emotional investment decisions, or nobody wants them to sell at the wrong time. And so I think the conventional wisdom of if we just don't sell, we can eliminate 50% of the mistakes.
At least, sure.
I think that's the general idea.
Yeah.
But it doesn't mean that there aren't periods where the conventional wisdom would dissuade an investor from selling when they really should, because the conditions would have changed.
Yeah. It's an interesting perspective, because I think, what we do in our profession, our job is to advise clients on both of those potential mistakes.
Sure.
And I think, to your point, a lot of advisors only choose one, right? They view it as their job to make sure that a client doesn't take action and make that mistake of taking action at the wrong time, but they forego the other one, which I think is a mistake.
Yeah, no doubt. Well, and obviously from our perspective and the lens, the way that we view things is that we want people to be invested in uptrends.
Mm-hmm.
There will be pullbacks within those uptrends that we believe that investors need to accept,
right,
as long as the overall trend is favorable for them. And we don't need people to get emotional at those times when we have those pullbacks within uptrends. I'll give you another good example. So let's rewind to 2020.
Mm-hmm.
The market had crashed during COVID. It had started to recover, and we're going into a heated election season, and the market's very volatile at that point in time. But importantly, it was in an uptrend.
Right.
And we believe that we didn't have the ability to predict who was going to win the presidential election in 2020. And even if we knew who was going to win. We didn't know how the market was going to respond to it. But a lot of people, they see that event, that seminal event of the election happening, as being some sort of market moving, type of an occurrence, and they get very nervous and they just want to retreat to the sideline.
Right.
But that was a period of time where we would have said, look, we have to focus on our process over trying to predict where the market's going. And if we're in an uptrend, this is a market you need to stay in. And thank God we did, because it took off afterwards. But not every case is like that. Go back to 2022, in a period where the market had already started to roll over, was in a downtrend. You had the Russia-Ukraine conflict start, markets moving down, and you have a lot of advisors that are telling their clients, you got to hang in there, you can't time the market and come out. And we would have said that's not the correct advice, because at that point you're fighting the fact that the market is moving lower. So I know we're going to get into that here in just a little bit.
Why don't we talk a little bit about some of the evidence that's presented in
Sure.
the forms of some of these studies that, and we refer to them in the white paper, but this is where I have a list of adjectives on the paper. I think nonsensical, hyperbolic garbage is what I wrote down.
Yes, yeah, for sure. And every time the market's volatile, you can expect to see these studies plastered all over the internet from most advisors, right?
So give me an example of what I'm talking about.
So, what they're going to say is, look, if you try to time the market, if you come out and you miss the best days, then it's going to have negative impacts on your return over time, right? So we can put the graphic up.
That's just math, right? Makes sense.
It's just math, right? But they say, hey, if over the last 20 years, that if you had been invested constantly in the S&P 500 and you accepted all the bad days but you got all the good days, your average annualized return during that 20-year period of time was 7.64%. But if you just missed the best 10 days, then that return gets a little more than chopped in half and goes down to 3.52.
Right.
And so, and then it gets worse than that if you continue to miss the next best 10, the next best 10. And so these are the studies, these are the statistics that are put out every time the market gets volatile, starts going down, as a way to try to convince people not to take the action to sell, right? That they have to stay in.
And at face value, that it seems logical, right? If you miss good days on the market, the math tells you it's not good for your return, right? And
that's correct.
I tell you, having been at other firms in the industry, I know a lot of very smart people that will send stuff like that to their clients in those time periods for that reason, right? They're trying to calm their fears, trying to tell them it's not the right action to take right now.
Yes, they're trying to assuage their emotions, right? And it's kind of going back to the discussion that me, you, and Joe had in that behavioral finance discussion that we had around the whole thinking fast, thinking slow, that when people are in their emotions and they're thinking quickly, they're trying to get themselves out of pain, right?
Yeah.
And so they can stop that quickly if they just step in and hit the sell button. And most advisors are trying to have them think more rationally about it, so they try to appeal to them statistically and say, well, look, if you come out and you miss these best days, it's going to hurt your return, right? And nobody wants to have their returns hurt, right? But the problem is that the cherry picking around this study, it is cherry picking to the nth degree. Yep. And we lay it out here in the paper, and I'm just going to go through it because the gymnastics that have to occur for this study to actually be someone's reality is not plausible in any way, shape, or form. And so, because what we notice is that these good days in the market, they tend to cluster around periods that we also see the worst days in
Absolutely,
the market.
yeah.
And so, we highlight just one particular example, March of 2020, when the market's crashing during COVID, that 2 of the best days in the history of the S&P 500 occurred during that month. And so, in order for this study that the industry puts out that says if you miss the best days, you're going to kill your return, in order for that to be true, this is what's involved in that. Okay, and let's put the calendar up just to make it really clear for everybody what this would entail. So you have somebody who's fully invested in the market through Thursday, March the 12th.
Right.
They can't take it anymore, and they sell after the market falls 9.5% that Thursday, sixth worst day ever. They can't take it anymore. They sell, they exit the market.
We're referring to the S&P here.
This is the S&P.
Yeah.
Yep. Lo and behold, the market rebounds on Friday the 13th, up 9.29%, 10th best day in the history of the S&P, and they regret the fact that they've sold. They're changing their mind, and they're going to get back in, but only at the very end of the day. They have to buy exactly at 4 o'clock. They can't capture any of the upside from that Friday. They buy exactly at 4. They get all the way back in, so they can be exposed to the market on Monday the 16th for the 3rd worst day in market history, down almost 12%. Mm-hmm. And they're going to endure that drawdown, be invested for almost another week, where they would have to sell at the close of business on Monday the 23rd, so they wouldn't be able to capture the return from Tuesday the 24th, which was the 9th best day in market history. There is no way.
And all of that to miss 2
Just
days.
to miss 2.
Right.
Right? That is so improbable that not only would somebody have to have the worst luck imaginable, right? You would have to try to be that bad.
Yeah.
And so this is where the cherry picking, is at its height.
So,
that
I mean, again, you look at the study at face value and you say to yourself, missing the 10 best days kills your return. But, when you actually start to step through it and see how nonsensical of an argument it is, the whole thing falls apart. And
what's the probability, though?
So, what's funny is, Shakti, our analyst, shout out to Shakti. He does great work here. And he and I were sitting down and trying to figure out what the actual probability was of doing something like this. So if you take, 260 trading days in a given year, over 20 years, 5,200 trading days.
Okay.
So for you to pull out, 10, 20, or 30 of the, best days in the market, basically the mathematical way to look at it, we think, we beat our heads together on this one a bunch, but is to look at you standing there, looking out 20 years, and then being able to pick out 1 out of 5,200 days and then doing it 10 or 20 or 30 times. And the probability of doing that is astronomically low. I think we came up with 10 to the negative 38th power of, we'll run all the zeros up here on the screen so everybody can see how insane that is. As we were going through this yesterday, all these analogies and metaphors started popping into my head for how unlikely something like that is. I mean, that would be, you shouldn't play the lottery because you might get struck by lightning going to cash in your winning ticket. It's probably more likely that happens.
Yeah, I'm sure it is.
I had, what was the other one I had? It would be like telling my kids to not jump on the trampoline because they might end up in orbit. Not impossible, but
have some quiet time. Right?
Improbable, not impossible. So like I started out with, right? Nonsensical, hyperbolic garbage. And when you really break it down, it's how can you use that as evidence?
It's never going to happen, right? But it's akin to a government statistic.
Sure.
Right? And then the other side of it that we go into is the antithetical right? The counter argument is, well, if investors are going to be presented with the data for why they should not sell because they might miss the best days, what if you had the ability to miss only the worst days, right?
But you never see that in any research.
You never see it, right? Because that might encourage somebody to try.
Sure.
Right? Because the returns that they get, let's pop it up here, right? All of a sudden you go from, you're just fully invested during this last 20-year period of time, average 7.64%. But if you take out just the worst 10 days, 12.41, right? You miss the 20 worst days, and all of a sudden your return annualized doubles, right? And then it's up 2.5 times if you miss just the worst 30 days. Now, this is as improbable.
Yeah, do we need to pop a disclaimer up on the screen?
Right.
Don't do this
Not
either.
possible, right? But the industry, right, the marketing machine of all these investment firms out there, they never show that side of it.
Sure.
Right? They only show, hey, if you try to time the market, this is what's going to befall you.
Yeah.
Right? And it's really with an aim. Their pursuit is just to try to neutralize everybody into taking no action whatsoever.
So what truly bothers me about all of this is that, it's an affront to the scientific process, right? The conclusion is already known.
Yes.
There's no hypothesis, right? So you can't print research like that and do it, without already deciding what you're trying to prove. And that bothers me, right?
Sure.
And there's tons and tons of that throughout this industry. It's one example, right? It's probably a good time to shift into, talking about the Brinson BHB study.
Yeah, because that's what all of this is fixed into, right?
Sure.
And so that study that was really an extension of Markowitz' modern portfolio theory.
We're referring to a study that was done by Brinson, Biebauer, and Hood, 1986, correct?
Yep.
We'll refer to it as the BHB study. Brinson, for whatever reason, gets the headline name.
He does.
I don't know why, but
I learned it academically as the Brinson study.
Sure.
I'm sure as you did it as well.
But I think that this study, the purpose of it was really to do an examination of the different components of the investment management process.
Sure.
3 components they listed were asset allocation, your mix of stocks and bonds, market timing, which really from their perspective was tactical portfolio changes, which is ironic. Sure. I don't even know if we'd consider that market timing today, right?
Or origination date.
Sure.
Right.
And third was your security selection, right? So
Sure.
what you're actually choosing as the vehicles you want to use. And so the goal for them was to figure out the attribution of those different components to a portfolio's return. And the way they conducted the study was they took 91 U.S. pension funds and basically compared the returns against a portfolio of indexes. Today we'd probably use ETFs, but
right.
they
It's
back in the day.
benchmarking, right?
Correct.
Yep.
And this is something I also found funny. So for the equity component, they used the S&P 500. For the fixed income component, they used the Shearson-Lehman Corporate Bond Index.
R.I.P.
Which,
Yeah.
I was joking yesterday that you can date somebody in this industry by how they refer to that index, right? When I started, it was the Lehman Aggregate Bond Index. Now, Then it became the Barclays
Aggregate,
and then
now
it was
Bloomberg, right?
There you go.
Yeah.
So, but anyway, they conducted this study, and their results were essentially that 94%, I think later revised to 92%, of the quarterly variation in investment returns within the sample set could be attributed to asset allocation. The 6% or later 8% was made up of market timing and security selection.
Yep.
So, the study itself, I think, had some flaws to it, right? The way it was conducted, there have been challenges to it over time, but, none of that is really as egregious as the interpretation of the study and how people took it and ran with it. So, the essentially what the industry locked onto was that 92% number. And, it was used really as a way of saying, as an investment manager, I can abdicate my active management responsibility because asset allocation accounts for most of our return.
Yeah, and God knows how many different presentations that I've seen it in. They throw up the pie chart. Let's throw up a sample pie chart for everybody that shows the thing that matters the most is your asset allocation, and these other two components, market timing, security selection, are so irrelevant to the process.
Right.
That's what they're putting forward.
Right.
That it isn't worth your time.
Right.
Right.
So the actual fact of the study and what, it's funny, we have a quote in here in that paper from Hood later saying, it was misinterpreted. That was never my intention to say that active management wasn't important. But really the lesson learned in the study is that in that quarterly time period, that narrow window that they were studying, the asset allocation did contribute a maximum amount to the portfolio variation. However, if you look at that variation that the market timing, the security selection contributed, and you compound those choices that those investment managers were making over time, sure, it accounts for much, much more. Right. And so a lot of the what do you call it? The issues that people took with that study, when they, rebuttals were done, was that they really looked at the wrong time period. They were looking at this, what happens within an individual quarter as a sample, when really they should have been looking at the length of the 10-year period that they were testing.
Yeah. And so again, what the industry was focusing on was the quarterly variability of returns, and conflated it with their actual returns themselves.
That's right.
And so, if I'll just give an example here, right? So not that I have any actual information relative to that study, but let's just say that one of these investment managers at the time that they owned large cap, they owned a lot of large cap U.S. stocks in one quarter, but perhaps they shifted during that quarter to own more mid cap or small cap stocks. Mm-hmm. By the time they were evaluated for the following quarter, the variability in their returns may be mostly accounted for by the fact that they switched from mostly large to maybe some mid and small. Mm-hmm. But it's not even focusing on the fact that perhaps that movement was accretive to the returns in that portfolio.
That's right.
So we're not so much concerned about why the returns were what they were, right? And I think some extensions of this particular study have said that if you look at the long-term performance of J.P. Morgan versus ExxonMobil, mm-hmm. okay, that the historical long-term returns for those two companies is probably somewhat similar, and it's likely because they're both large cap U.S. stocks.
Sure. Yeah.
But that's not to say that there aren't quarters or years where one of those names wildly outperforms the other, mm-hmm. right? Mm-hmm.
So this is, to the point I made earlier, right? The conclusion from the people reading this study and interpreting it was already known. And so this is a poor case of, what I'm going to call evidence fitting, right? They were essentially looking for evidence to back up the thing that they already knew.
And what was that?
And that was that buy and hold is the method that you should use.
Well, and it's more of, I think they were looking for statistical evidence that they could publish that suggests that a more passive investment strategy, right, or investment discipline is what people needed to follow.
Right.
And guess what? That's scalable for our industry, right?
Well said.
Just have as many people go into these passive investment strategies that are asset allocated, don't make any changes, and that's something that they can do till the cows come home.
Yeah.
Right? And they really aren't interested in doing a whole lot else.
And, we love our behavioral finance, behavioral economics here, and this is probably one of the worst cases of confirmation bias I think I've ever seen in my life.
100%.
Right? Again, you're using this manufactured evidence to support your already known conclusion. So
this particular study, right, has been bastardized in such a significant way because, again, as you said, Hood even came out and said what they're latching onto and putting out there as the real finding in this study, that's not what we're suggesting at all.
Right.
But you wouldn't know that, right? You wouldn't know that just looking at the evidence that you see online. So, but let's go on to this idea of if you actually examine the occurrences of these best and worst days, right? We already mentioned that they tend to cluster together.
Yep. It's almost uncanny when you look at, and it's funny, as we were preparing for this, I started pulling just a list of returns using the S&P, and it's almost uncanny how you read down the list of the best days and of the worst days and that they're all the same years, right?
Yeah, they tend to cluster together. Oftentimes they're in the same months. There are occasions, and we saw with that chart or that calendar from March of 2020, sometimes they're in the same weeks. But if you take a step back and look at when these best and worst days are occurring, they're tending to occur and cluster together in markets that are going down. Right? And so...
And it's another one of these things that I think is, it's well known with folks that work in this industry that things get volatile when markets are heading the wrong direction. But, to take that step back and look at these two analyses side by side, right? Best days and worst days within that context, you never hear about that, right?
That's right. And so, again, this kind of goes to, we first examined how there's no way that somebody's going to only miss the best days or only miss the worst days because of all the gymnastics associated with it. But again, the time of when this advice becomes most pervasive of you can't time the market, meaning you shouldn't sell, it's a dog whistle, right? It's a dog whistle to try to discourage people from exiting their portfolio. And you don't see it when the market's moving up. You see it most often in periods of volatility or when the market's moving down. And so let's pop the other chart up here, just another example of clustering together of some of these best and worst days. This is from back during the financial crisis, that all of these bad days and good days, they're taking place right around similar times in markets that most investors would not want to be involved with anyway, right? And so in our mind, it would be better off for clients or investors just to forego being invested in downtrends anyway. And some of the statistics could support that. And
what's a little interesting about this chart too is, we show that some of the worst days and best days of market history happened in this period, and I think we looked at, I don't remember when, but it was 2008-9 time frame, right?
Yep.
And if you pull out, we're gonna do a little cherry picking of our own here.
Yes.
If you pull out the most volatile periods in market history, the 20s and 30s, where obviously we had an event, right?
Yes.
If you pull that data out, this chart lights up. You start seeing just days in 2008 that were, big magnitude move days all over the place. It's really incredible what happened during that period in terms of volatility. And obviously the folks that worked in the market at the time know what that felt like.
Correct. So, people that were invested, I think they remember what it felt like too, right? But if we start to say, all right, knowing that these best and worst days cluster together in downtrends that what if instead of the cherry picking of I only miss the best days, I only miss the worst days, if there was an idea of saying, okay, what if I wasn't invested in the downtrends and I knew that I was going to forego the best days, but it would simultaneously free me from being exposed to the worst days, what happens to my return through time?
Sign me up for that.
Right? And so that's all of a sudden when the data starts to get very interesting, that we notice that our return profiles improve, right? Returns improve as you miss the 10 best and 10 worst, 20 best and worst, 30 best and worst. And not only do our returns improve in that study, but risk comes down.
Yep. Your standard deviation becomes lower.
Your standard deviation comes down because you're not exposed to those really volatile days, right? Those really volatile periods.
And if you think about it again, it's just math, right? The idea that if you're able to smooth the ride, right, you're able to eliminate these big volatile moves within your portfolio, naturally you would expect, number one, that the thing we use to measure risk comes down. And then number two, you would expect that the ability for those returns to compound without big drawdowns would improve your long-term returns.
That's right. And it gets back to this just mathematical principle that losses are exponential.
Right.
If you lose 20%, you have to make 25% to get back to even, right? $100 goes to 80. You got to make 20 on 80, 25% to get back to 100. You lose 33%, you got to make 50. And so being able to minimize drawdown is a significant factor to improve long-term returns if you're not having to dig out of some of these holes. And so this idea or this study that if you could eliminate the best and worst days, that as an investor, potentially it allows you to have your cake and eat it too, in that you could be looking at potentially better returns, less risk, and that's really what everybody wants.
You would hope so, yeah. So where does that leave us?
Well, I think where it leaves us is, understanding first of all that the asset allocation, diversification piece is important, but it isn't the end all be all for everything. It's a starting point. It's an origination point, and we don't think that people should make emotional investment decisions that they see something bad happen on the TV. They're not going in and selling just because. They're not following some prediction of XYZ is going to happen in the next 90 days. I need to get out, or this is some buying opportunity of a lifetime. That investors are going to be benefited simply by observing market trends and aligning with those trends. They can keep themselves out of harm's way. They don't have to experience those big drawdown days. Missing the best days won't kill them if they've missed the worst days too. And ultimately, we think that is something that is more achievable, and it's something that we seek to achieve using our rules-based investment discipline.
Yeah. Can you time the market?
You cannot time the market.
Should you try?
You should not try. But you can discern a trend, right?
Fair.
So it would be a fool's errand to try and pick a top, pick a bottom, step back, gain some perspective. The trend is your friend. It's going to keep you out of trouble, and it's ultimately, we believe, going to translate into better returns for you through time and the ability to sleep at night when it matters the most.
There you go.
Anyhow, listen, hope everybody has enjoyed this discussion. This is a discussion that we think is going to become more prevalent, more frequent as we go ahead. We've been in a bull market here for a while. It's not going to be that way all the time. And so when this analysis is presented by the marketing machines out in our industry, it's going to typically happen as the market starts to roll over and move down. And so
if you start seeing those analyses out there, you should worry a little bit. Is that
I would think that you should at least question what's going on.
There you go.
Right? So anyhow, thank you everybody for joining us. For Michael Bennicelli, I'm Stephen Weitzel, and we will see you next time here on Bugle Notes.
And make sure to read our white paper if you haven't already.